$2 billion. Gone. Not stolen in a heist, not lost in a market crash, just gone. Vanished from bank accounts that auditors had been signing off on for years. And when the world's most respected accounting firm finally asked the banks in the Philippines to confirm the money existed, the banks said they had never heard of Wirecard in their lives. That was June 2020, and within days, a company worth $24 billion ceased to exist. This is the story of how a payments company nobody had heard of became the pride of Germany, fooled the entire financial establishment of Europe, and then collapsed so spectacularly that it rewrote the rulebook on corporate fraud forever. In the mid-2000s, Wirecard was a small, unglamorous German company processing payments for online casinos and adult websites. Not exactly the kind of business that fills boardrooms with excitement. But then something changed. The company pivoted aggressively into mainstream digital payments, and the timing could not have been more perfect. The world was going cashless, smartphones were everywhere, and investors were desperately searching for a European answer to PayPal, to Visa, to the Silicon Valley giants that were eating the continent's lunch. Wirecard positioned itself as exactly that answer. The Munich-based company grew at a staggering pace. The revenues climbed, the partnerships multiplied, the press releases were relentless. And at the center of it all stood a quiet, composed, bespectacled man named Markus Braun, the CEO who dressed like a philosopher and spoke like a visionary. He talked about Wirecard not as a payment processor, but as a technology ecosystem. He made people believe they were not buying a company, they were buying the future. By 2018, Wirecard had done something that would have seemed laughable a decade earlier. It replaced Commerzbank, one of Germany's oldest and most storied financial institutions, inside the DAX 30, the index of Germany's 30 most valuable companies. The country celebrated, the financial press celebrated, and institutional investors across the United States, the United Kingdom, and Europe poured money in. But a small group of people were not celebrating. They were deeply, quietly, increasingly alarmed. The Financial Times journalist Dan McCrum had been investigating Wirecard since 2015. What he found, piece by piece, was a company whose numbers did not add up. Profit margins that seemed too good for the industry, revenue streams that could not be independently verified, a web of third-party partners in Asia, companies in Dubai, Singapore, the Philippines, that were supposedly generating enormous profits on Wirecard's behalf, but that were almost impossible to trace or confirm. McCrum and his colleagues published their findings, and what happened next was extraordinary, not because Wirecard was investigated, but because McCrum was. German financial regulator BaFin, instead of turning its scrutiny toward Wirecard, launched a criminal complaint against the journalists. It accused them of market manipulation. The implication was clear. The journalists were the problem. Wirecard, a national champion, was the victim.
Short sellers, investors betting that Wirecard stock would fall, were painted as financial terrorists trying to destroy a great German company for profit. The German financial establishment closed ranks, politicians echoed the sentiment, and Wirecard stock kept climbing. This was not just a failure of oversight, this was active institutional protection of a fraud. Inside Wirecard, the architecture of deception was breathtakingly sophisticated. The company claimed to generate a substantial portion of its revenue through third-party acquiring partners, businesses in Asia that processed payments in regions where Wirecard did not have a direct license to operate. These partners would collect the money, take a cut, and pass the rest back to Wirecard. On paper, it looked like a perfectly reasonable business model for a fast-growing global fintech company. The problem was that a significant portion of these partners were either fictitious or heavily manipulated. Revenue was fabricated, contracts were forged, and the supposed profits from these arrangements were held in escrow accounts at banks in the Philippines, accounts that appeared on audited balance sheets to hold over 1.9 billion euros. Ernst & Young, one of the most prestigious audit firms in the world, had been signing off on Wirecard's accounts for a decade. For years, they accepted confirmations of these balances without independently verifying them directly with the banks. When they finally did, in the chaos of 2020, as pressure from the Financial Times reporting became impossible to ignore, the Philippine banks gave a response that sent shockwaves through global finance. They said the documents were fake. They said the account balances did not exist. They said they had no meaningful business relationship with Wirecard at all. The money had never been there. On June 18, 2020, Wirecard made an announcement that stopped markets cold. The company said it could not confirm the whereabouts of 1.9 billion euros that should have been sitting in trustee accounts. It was, in the dry language of corporate disclosure, one of the most devastating sentences ever published by a publicly traded company. The stock collapsed. Over 70% of its value was erased in a single day. Billions of dollars in wealth held by pension funds, retail investors, institutional managers across Europe and beyond evaporated. 4 days later, Markus Braun was arrested at Munich airport as he attempted to return from a trip abroad. He was charged with fraud, market manipulation, and breach of trust. He has maintained his innocence, and his trial continues in Germany. But the figure who has captured the darkest imagination in this story is not Braun. It is Jan Marsalek, Wirecard's chief operating officer, the man believed to have been the operational architect of the fraud. Marsalek fled Germany 2 days before the company's collapse was announced. He has never been found. Interpol has issued a red notice for his arrest. There are credible reports connecting him to Russian intelligence networks. As of today, Jan Marsalek remains one of the most wanted fugitives in the world. A ghost who moved through the highest levels of European finance and then simply disappeared. The human cost of the Wirecard collapse is not captured in the headline numbers, as staggering as those numbers are. Thousands of ordinary investors, retirees in Germany, savers across Europe, pension funds in the United Kingdom lost life savings. People who had been told by analysts and fund managers and financial media that Wirecard was a safe, high-growth holding. People who had no way of knowing that the foundation beneath the company was hollow. Employees who had built careers inside Wirecard, believing in the mission, proud of the product, found themselves unemployed overnight, their stock options worthless, their professional reputations entangled in a scandal they did not create. And the creditors, banks that had extended over 3 billion euros in loans to the company, were left fighting over the ruins of a business that turned out to be built on air. What made Wirecard possible, what makes any fraud of this scale possible, is not one villain in one room. It is a cascade of incentives, blind spots, and institutional failures that allow a fiction to calcify into accepted reality. Auditors who grew too comfortable with a long-standing client, a regulator that confused national pride with diligent oversight, journalists and short sellers who spotted the truth years earlier but were dismissed as bad faith actors, investors who were so eager for a European technology success story that they punished skepticism and rewarded belief. The Wirecard scandal triggered a sweeping overhaul of Germany's financial regulatory framework. BaFin was restructured. Ernst & Young faced intense scrutiny and legal proceedings. New rules around audit independence were proposed across the European Union. The scandal became a case study taught in business schools across the United States, the United Kingdom, and beyond. But regulation changes slowly, and the appetite for the next great story, the next company that seems too exciting to question, never really goes away. The 1.9 billion euros has never been recovered. Jan Marsalek has never been found. And somewhere in the archives of Germany's most ambitious financial decade, there is a photograph of Markus Braun on stage at a technology conference, arms open, speaking about the future of money with total conviction, while the accounts his company was built on existed only in forged documents and manufactured spreadsheets. The lesson Wirecard leaves behind is not simply about fraud. It is about the seductive power of a story that people desperately want to believe, and the very high price paid by those who could not afford to be wrong.